Okay guys, we'll be looking at 429A on page 226, presented as Erickson Real Estate Appraisal, their adjusted trial balance at June 30th, 2018. Our first requirement is to prepare their income statement for the year ended June 30th, 2018. So just like we've prepared all of our other income statements, we will record the revenues, service revenue, and then list each expense, add up the total expenses, and if you notice, this time our total expenses are more than our total service revenue. We're not used to that. So because of that, the company has a net loss. When expenses are more than revenues, net loss. So this is a new learning experience. Let's see what happens. When we complete our statement of owner's equity, in step 3, they want us to complete a report form, classified, balance sheet. So we start off our balance sheet as we always have, name of the company, balance sheet, and the date, June 30th, 2018. We label our asset area. We now begin with current assets, our first category of assets. Remember, those are assets that we will use up or collect by the end of next year. Cash, accounts receivable, office supplies, and prepaid insurance. We add those together to get our total current assets. Now, if you look, we now have 3 columns on our balance sheet, and that's fine. You could have 4 or 5 or 6. It's only because of the amount of subtotaling that is occurring on here that we didn't have before. So I wouldn't get too worried about it, just as long as you put all of your current assets together and they're in financial liquidity order. You add them up and label them total current assets. Property, plants, and equipment is the other major category of assets. Remember, these are long-term assets that are tangible that you'll use in your business. Now, the other day when we were working on our in-class problem, there was only 1 property, plants, and equipment. But now we have 2. And remember, we have to subtract accumulated depreciation from any assets that have it. Now, land is not depreciated, so we just put the dollar amount of land. But in that inner column, we're going to put the cost of the building, which is the balance of the building account, $82,000, subtract that contra asset accumulated depreciation building. Remember, all that's in there is all the expense that has been taken on the building so far of the $82,000. We subtract that, and then we get what we call book value. The difference is called book value, $56,800. That doesn't mean Kelly Blue Book value. It just means that's the value that's of the asset on the books of the company. Now add the land and the $56,800 book value of the building together, and we get our total property, plants, and equipment. So because of all that subtotaling and adding together of the various assets, we end up with 3 columns. That's the only reason. So we add our total current assets to our total property, plants, and equipment to get total assets. In the second part, we will add our liability label and then we categorize our liabilities between current and long-term. In this company's case, all of their liabilities are current except for the note payable, and it tells us on the trial balance the note payable is long-term. So we will add each accounts payable, salaries payable, and unearned revenue, the four current liabilities, add them up, put the total, and label them. Then we will put the heading long-term liabilities, only list the notes payable of $40,000. So we've separated our liabilities between current and long-term. Add current to long-term to get total liabilities. The last area of our balance sheet is reporting the balance of owner's equity as of June 30th, 2018. So we'll put Erickson Capital. We've already determined that on the statement of owner's equity in the previous slide, $5,700. Add your total liabilities to equity, and you get total liabilities and owner's equity, which agrees to total assets. So we need to know this balance sheet, which is a classified balance sheet because it breaks the assets and liabilities down between current and long-term categories. This is a report form because assets are listed first, underneath is liabilities, and then owner's equity. Okay, once we're done with our financial statements for the year, remember, now it's time to clean up. We just had the party, it is time to clean up. Now we must do our closing journal entries. Remember the purpose of a closing journal entry. It's to reset or clear out the temporary accounts so that they will have a zero balance in them after you post these journal entries. What are our temporary accounts? Revenues, expenses, withdrawals. We're only allowed to accumulate 1 year's worth of information in them at a time. When that year's up, after the financial statements are done, clear them out. So these are very standard. Remember on the test, I'll just say, do the closing journal entries. You will need to know these 4 journal entries. The first journal entry, we will debit service revenue, decrease it so that it will have a zero balance. Credit that new account called the income summary. We only use during closing journal entries. The next journal entry, credit each expense for its current balance. When you post that, the balance in each expense will then be zero. Debit the income summary for the total. Now, I can't flip around slides here and show you the various T accounts as we go, unfortunately, or else I'll never have this recorded properly. So what I want you to do is draw a T account with the word capital at the top. And then actually, I want you to draw one with the word income summary first. Sorry. Okay, income summary. Now, what did we just do? We posted $48,100 to the income summary account on the credit side. First journal entry. Second journal entry, we posted a $57,600 debit balance or debit amount. Okay, so remember what I said to do in step 3. Determine the new balance in the income summary. So if we take the $57,600 minus the $48,100, 005. If I did my math right, $9,500. And the balance will be on the debit side of the income summary account. Yes. Why is that? Because there was a net loss. The other day when we were working on this, the balance in the income summary account ended up on the credit side because revenues were greater than expenses for the year. So there was a net income, which was the credit balance. But in this case, in this example or problem, there's a net loss. So the expenses, which are on the debit side of the income summary account, are greater than the credits. Okay, so the balance is $9,500. It agrees to the net loss. We need the income summary to be zero. So how do we do that? Credit the income summary account for $9,500. Debit capital for $9,500. The loss. Net losses decrease capital. Net incomes increase capital. So make sure you take a look and understand both of these journal entries, whether it's net income or net loss. The final closing journal entry is where you will reset withdrawals to zero. You will credit the withdrawals account 27,300 because it has a debit balance in it of 27,300, and then debit the capital. So those are your 4 journal entries. The first 3 is getting net income into the capital account, or net loss into the capital account. How do we do that? We first reset revenue to zero, essentially move its balance into this account called the income summary. The second journal entry, reset each expense to zero and move the total balance of $57,600 into the income summary. Determine if there's an overall net income or net loss for the year, and that would be the balance in the income summary account. Remove the balance in the income summary account and by crediting it in this case and debiting the capital. In my one class I explained it as the income summary account is kind of a layover. Okay, we're trying to get from those various accounts service revenue, the expenses, and the withdrawals. We're trying to get a flight to capital. Okay, service revenue and the expenses have to do a layover before they get to capital, and the layover is income summary. So we collect the net income or net loss in the income summary before it gets to its final destination, the capital. Withdrawals has a direct flight. So if you want to look at it that way. Okay, so once we do these journal entries, now the general ledger is going to look a little funky here, so you might have to look at this presentation a few times, but that's okay. Now, I know this looks different than what we're used to, and it's just because the shading and how I copy and pasted the answer key, but you could see cash doesn't change, accounts receivable doesn't change, office supplies don't change, prepaid insurance does not change, or land during this process. Now we have more assets, they're down below. But if you take a look, what does change? Look at service revenue. Service revenue has a debit in it. There's the posting of that first journal entry, 48,100. Afterward, it has a zero balance. Income summary is credited 48,100. That's the CLOS over in the credit side. Then each expense is credited. You could see where the original balance was a debit for our first 2 at least, and then the closing journal entry crediting it, and that's closing journal entry 2. You'll see the rest of those in a second. But look what happened to the income summary account. We debited it. The third step was determine the balance. So after you post those 2 journal entries into the income summary, determine its balance. So the debit balance of 9,500 is really the next step, what you determine. But step 3 then says, okay, we got to get rid of that $9,500 debit balance. So we're going to credit the income summary, and you'll see it in a second. We're going to debit capital. And that's what should happen. A net loss should decrease capital when you're closing out the balances. The final journal entry you could see in the withdrawals. We credited withdrawals 27,300. So all of these accounts now have a zero balance. And as we go through the rest of these slides, you'll see the effects on the other ones. Building was not affected, accumulated depreciation was not affected. But look at supplies expense decreased to zero. That's the second journal entry just being posted into that T account. Interest expense decreased. That's just the journal entry being posted into the T account. We'll go to the last area. I know this is very small, but you could see accounts payable, the balance didn't change. It's still 18,700. Interest payable, salary payable, unearned revenue, notes payable. So none of the assets or liability balances change during this process. They shouldn't. They're not involved in this process. What are? Revenues, expenses, and withdrawals. So there's our remaining expense amounts. They were closed out or reset to zero. And you can see CLOS is the credit to each of those accounts to reset them to zero. Finally, down at the bottom, you could see the 2 debits going into capital. One for journal entry number 3, where we moved the net loss out of that income summary account by crediting it and debiting capital. And then the second one is for the withdrawals. We credited withdrawals, We now have to move that balance into the capital. So after we've subtracted net loss for the year and withdrawals for the year from Erickson Capital, there's their new balance, and that agrees to the statement of owner's equity, and it should. So that's what the company owes Erickson as of the end of the year. The final part of our accounting cycle is just making sure debits and credits are equal before we go into the next accounting year and start the cycle all over. So all of our permanent accounts, those we do not reset to zero, that's all permanent means. You don't reset them to zero. All of those accounts will be on this last trial balance because they're the only ones with balances. Where do we get these from? The general ledger. So you can go back to those previous slides and see it. Cash still has a debit balance of $4,600. Accounts receivable still has a debit balance of $5,300. Office supplies, $1,500 debit. Prepaid insurance, $1,700 debit balance. Land, $13,000 debit balance. Building, $82,000 debit balance. Accumulated depreciation building, remember that's our contra asset, credit of $25,200. So all the assets still the same from the adjusted trial balance through the closing process. Then we have the 4 or 5 liabilities. Accounts payable still has a balance of $18,700. Interest payable still has a credit of $8,500. Salaries payable, credit of $2,400. Unearned revenue and notes payable. So just one more time, those balances do not change during this process. The only permanent account balance that does change is capital, and it's just updated to its new balance. It's not zeroed out. You do not reset capital to zero. You reset the components of capital to zero, which are withdrawals, revenues, and expenses. Those are the 3 items that we accumulate during the year and show their effect on at the end of the year when we're doing our financial statement. When that year's over, they're reset to zero to accumulate them for the next year. So once again, Erickson Capital is at a credit balance of $5,700. Add up your debit column, add up your credit column, make sure that they equal. If they equal, you're ready to start the next accounting year. Okay, so that wraps up our review of problem 429A. If you have any questions at all, email them to me. We will make sure that we have them all answered before the test on Monday.